Hello and welcome to our YouTube channel Finbuzz Learning. Today we will understand the swap contract in detail. So let's begin with the meaning of a swap contract. So the swap contracts are financial derivatives that allow two trading parties to switch revenue streams resulting from some underlying assets that they both own. Let's take an example to understand this further. Let's consider the situation of an American company that wishes to conduct business in the UK but has borrowed money in USD from a bank with a US presence. The company's cost and revenue are expressed in many currencies. Although it makes income in GBP, it must pay interest in USD. However, it is vulnerable to risk brought on by chances in the USD/GBP currency rate. Thus, in order to protect itself from danger, the corporation can use a USD/GBP currency swap. The company must locate a willing party to take the other side of the swap in order to complete the transaction. It may, for instance, search for a UK company that markets its goods in the US. It should be obvious from the way currency swaps are structured that the two parties involved in a transaction must hold divergent opinions on how the USD/GBP exchange rate is moving in the market. Now, the swap contract is further classified into three different types, so we will understand each of them in detail. The first type of swap is interest rate swap. So, it is an agreement between two parties to exchange interest payments is known as an interest rate swap. Interest rate swaps allow their holders to swap financial flaws associated with two separate debt instruments. Businesses that incur costs linked to a fixed interest rate debt instrument or generate revenues linked to a variable interest rate debt instrument are the most likely to use interest rate swaps. Let's understand this with the help of an example. Think about a private mortgage company that finances first-time home buyers. In other words, if the central bank sets an interest rate of 2%, the private mortgage provider can provide a loan for 2.25%, which is a 0.25% premium over the current interest rate. It is obvious that the income of the private mortgage provider depends on the interest rate decided by the central bank. Now, another type of swap is a currency swap. A currency swap is an arrangement between two parties where the principal and interest of a loan are exchanged for the principal and interest of the loan in a different currency. They are over-the-counter derivatives that have two main uses. The first is they can be used to reduce the cost of borrowing abroad, and the other one is they could also be employed as instruments to reduce exposure to a currency rate risk. So, coming to the last type of swap, which is hybrid swap, in which holders of hybrid swaps can exchange the financial flaws linked to several debt securities with different currency denominations. For instance, a US company that offers variable rate mortgages and conducts business in the UK can convert a fixed rate loan with a USD interest rate into a variable rate loan with a GBP interest rate. Swapping a loan with a variable interest rate in USD for one with a variable interest rate in GBP is another example of a hybrid. Now we will be knowing the different advantages of a swaps. Borrowing at low cost is one of the advantages of the swap. Swap enable borrowing at more affordable rates. It operates under the tenets of Ricardo's theory of comparative cost. The comparative advantage of one borrower is swapped for the comparative advantage of the other borrower. Now, the next advantage for the swaps is they have access to a new financial markets. By examining the comparative advantage, the other party in the market possesses a swap is utilized to gain access to new financial marketplaces for funds. Therefore, through a swap, each party's comparative advantage is completely utilized. As a result, money can be received from the best source available for less money. Another advantage is hedging of risk, in which Swaps can be utilized to reduce risk as well. As an illustration, a business has issued fixed rate bonds. It has a strong impression that future chances in the economic environment will cause the interest rate to drop. Therefore, it must swap out the fixed rate obligation for a variable rate obligation in order to gain in the future from the decline in interest rate. In other words, the business must enter into a swap agreement with the counterparty under which it will get fixed rate interest and pay floating rate interest. Swaps are a great tool to correct asset liability mismatch. Asset liability mismatches can be managed profitably by using a swap. For instance, a bank has purchased an obligation that bears interest at a floating rate on the one hand and an asset that bears a fixed rate on the other. The bank would be significantly impacted if interest rates rose because the bank would have to pay more interest as a result, due to the fact that the interest payment is based on a fluctuating rate. This is the case. However, because the interest received is based on a fixed rate, it won't increase. Last but not least, swaps give additional income. So into swaps, financial intermediaries can generate additional revenue in the form of brokerage by setting up swaps. Now, there are certain disadvantages of swap contract also. Let's understand them also. The first disadvantage of a swap is to find a counterparty to represent the other side of the transaction in challenging. It is not required for other companies to be willing to swap the same amount with the same maturity. If one company wants to trade $1 lakh, which is a flow in the swap market. On the other hand, the swap agreement involves a large amount of default risk and cannot be terminated without the consent of all parties participating in the transaction, making it a dangerous instrument to utilize. Also, swaps are illiquid and cannot be exchanged as easily as equities or currencies, since the secondary market for them has not yet grown to its full potential. Now, the last disadvantage is that there is no exchange to guarantee that the parties involved in a swap will fulfill their obligations, because the swap market is an over-the-counter market that is not exchange monitored. As a result, parties must carefully consider the creditworthiness of the counterparty. So, this was all about the swap contract. Hope you guys now get the topic properly. We will understand a new topic in the next video. Do like, subscribe and share the channel. Thank you for watching and have a wonderful day ahead.